Okay, you probably think by now that I'm going to be putting my boot into all of these methods, but it's not as bad as that. We're going to talk about payback period now. And payback period is something you might want to use if you have, if you're very risk averse, and you've got some real problems anticipating cash flows further out. So what really matters for you is that you get your money back reasonably quickly. And as the name suggests, that's what the payback period is basically looking at. How quickly are you paid back? So the payback period is basically defined as the length of time it takes you to get your cash flow back, get your investment back from the cash flows that the project generates, right? So the shorter, the better, because the shorter that period is, the quicker you've got your investment back, and everything after that is pure profit. Now, payback usually, it still doesn't take into account time value of money, so it is sort of a little bit dodgy, but by saying how quickly it's paid back, it's sort of taking into account timing. But there is a discounted payback period that's a little bit closer to what we'd like to be doing. Okay, so let's have a look. Example, we've got a payback period question. The investment was 18,000. The annual cash flows are 5,600 each year for 5 years. So simple. If the cash flows are the same, we just say 18,000 divided by 5.6. After about 3 and a bit years, we've got our money back. Obviously, if the cash flows aren't even, well, then you accumulate them and you just see in which year you finally made your money back. Advantages, it's pretty simple to calculate. You've still got to forecast cash flows, but hey, you've got to do that with most of the methods anyway. It's easy to understand, and it's really good in situations where getting your money back quickly is more important than maximizing value. So, you might say, hey, we're going to have cash flows of 1,000 for the next 5 years, and then after 12 years, it's going to go to $1 million a year. But that's so far out and so risky, and it may not happen. You really want to focus on the thing that gives you your money back. So if you do fail, you can redeploy resources because you've got them back into something that's less likely to fail. Mind you, if you made the riskier decision, it might have been better for you in the long run. We don't know. So there is a bias towards things that give you cash pretty quickly, and it sort of implicitly takes into account risk. It basically says, hey, we're not discounting anything within the payback period, but everything beyond the payback period we're ignoring. In other words, we're weighting them really heavily for risk and time value of money. So, it's sort of implicitly taking into account an attitude towards risk. Okay, so it can be useful. Mind you, explicitly, it doesn't actually give any considerations of time value of money. The cutoff period, well, how soon do you want your money back? It's arbitrary, but that doesn't mean it's wrong. It might be relevant in some situations. And as I said before, if you've got a project that generates low yields in early years and high yields later on, it will be biased against them because the payback will be longer, even though they may have a greater value in the long run. And as I've already said, effectively, once you've got your payback, you don't care about the cash flows that happen afterwards in doing the calculation. Okay, so these are some of the disadvantages. And one way of dealing with them is by going and doing a discounted payback, which is just a slight variance on the basic payback period. So what you do in discounted payback is basically you still predict out the cash flows and you discount them, and then you accumulate the discounted cash flows to see when you've paid back your investment. Okay, so it takes into account time value of money. It'll mean the payback's a bit longer, but you're sort of coming closer to this idea that capital has a cost and earlier dollars are better than later dollars. And even within the payback period, they are better. So if you've got a payback period of 5 years for 2 projects, obviously the one that's giving you most of the cash flows up front is better than the one that gives you most of the cash flows later on. Okay, so let's just sum up what we know about the accounting rate of return and the payback. We know that the accounting rate of return is easy in the sense that we're usually predicting accounting numbers anyway. That's one reason you might choose accounting rate of return. We know that payback method, it's good because it takes into account risk in an implicit sort of way, but it's bad because, well, it doesn't take into account time value of money. Okay, so let's have a look at workshop question 1. Billy Blue is considering purchasing a new machine, costs $50,000. It's going to generate income of 20, have cash expenses of 6,000. All of this is before tax. The machine's going to have a life 5 years, 0 residual at the end of 5 years. It's going to depreciate down to 0. and the tax rate is 30%. So let's work out accounting rate of return and the payback period. Okay, so accounting profit, it's going to be the same in each year, right? So we're going to have 20,000 is the income. The expenses are going to be 6,000. Okay, that's the basic cash expenses. The depreciation, this thing is depreciating from 20,000 down to zero over 5 years. Oh, sorry, it costs 50,000. So it's going to depreciate down to zero over 5 years. So that's $10,000 depreciation. Profit before tax is 4,000. Tax at 30% of 1,200. So your profit after tax is 2,800. Okay, 2,800. So the average book value, 25,000. Okay, starts at 50,000, finishes at zero. So the average is 20,000. The average profit we've worked out is always 2,800. So your accounting rate of return is about 11%. Okay, to work out the payback period, what's your operating cash flow? Well, earnings before interest and tax we've already established was 4,000. We take off the tax, that means that our after-tax profit is 2,800. But remember, in getting to that EBIT of 4,000, we took off depreciation, which is not a cash flow. So we add back the 10,000 because it wasn't a cash outflow. So operating cash flow each year is 12,800. Compare that to a payback period of, compare that to an investment of 50,000. We get the cash back after just under 4 years. Okay, so that's how we do the calculations. Now let's look at actually using payback for making decisions. Oz International is looking at a new item of plant. Basically, it's interested in a 3 years cutoff for its payback. So it wants its money back within 3 years. And here are the cash flows we're given. A $20,000 investment, cash flow of 10, 12.5, then 0. Then in the last year, -5. Oh my God, we've got to pay to get rid of it. Okay, but you can already see here that the payback's going to happen within the first 2 years. Even though further down the track, you're going to have to spend more money. So does this project actually have a positive net present value? I don't know. Might not be worth taking the project. But what is payback going to tell us? It's going to tell us that, hey, after 2 years, we've got our cash back. Okay? Year 0, we've paid out. Date 0. Date 1, accumulative cash flow is still negative because we've only had 10,000 come in. The year 2, 12.5 comes in. So we're now ahead of the game. So 1.8 years. It's less than 3 years we take the project. If you did a net present value calculation on this, and I encourage you to maybe do some calculations, I don't know, assume a 10% rate of return, whatever, is it going to give you something that you're likely to take? What sort of rate of return will it give you? At 10% will it give you positive? At 5% will you give you positive? Are you willing to tolerate those rates of return?